Good morning and welcome to the EJF Investments Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you up to CEO Neil Wilson. Good morning to you, sir.
Great. Thank you very much, Alessandro. And thank you very much to Investor Meet Company. It's a great platform that you've built, and we're very pleased and proud to be on it for the first time. This is our inaugural presentation. So my name is Neil Wilson, as Alessandro said. I am a founder of EJF Capital. We're celebrating our 20th anniversary. As you can tell by my accent, we're based in America, just outside Washington, D.C. We also have a research office here in London. And of course, we have the closed-end listed investment trust that we'll be talking about today. I am the Chief Executive Officer of the investment trust and of our London operation. So in terms of the first 6 months, I'll drill on that in a moment. But first, what I'm going to do is talk a little bit about EJF Capital, just because this is our inaugural presentation. So as I mentioned, this is our 20th anniversary. I'm one of the founders. We manage $5.5 billion. So our investment trust is quite small relative to our other products, but it's a very important aspect of what we do, and I'll explain why. In terms of what EJF Capital does, we position ourselves as regulatory event-driven investors. I'm a former attorney. And I used to work at the Securities and Exchange Commission in Washington, D.C. My partner is also a former attorney, and we focus on regulatory change and how that creates and informs investment opportunities. What that really means when you pull it away is that we focus on regulated industries, and we look at changes in regulation and how that impacts those organizations. So think about banks. So we focus on banks, insurance companies, REITs, business development corporations, and the like. And for this trust, what we're focusing on the trust is an expression of what we're doing in private credit, debt issued by banks in America and insurance companies, and also loans that are on bank balance sheets. And that's we do have a CRT strategy that I'll get to in a little bit, but that's an emerging strategy. So the exposure here is U.S., and it's really playing into our expertise. We're known as the small bank guys in America. America is a very unique country in many ways, as we're seeing by some of the dysfunction that we periodically have. For example, the government being shut down here for a few days. That seems to be a biannual event, but the government in America does in the end have a positive economic program, and the U.S. economy right now is very strong. So we think this is a very strong area to be investing in at this time. I would let me, if I can go back to the trust. Overall, as a firm, we manage about 25% of our investors are pensions. We have 3 sovereign wealth funds that invest with us, and we're on many high net worth platforms. In terms of the trust, I'll get to it in a moment, who are some of the UK investors. They're both institutions as well as retail investors. So we started this trust back in 2017, so just a little over 8 years ago. I would focus on that third circle there, which is that we've had over an 8% annualized return over that 8-year period. Remember, during that period, we've had 2020, we had the COVID crisis, which bank stocks went down 40%. Again, we're only investing in debt issued by banks. You don't have that kind of volatility, but it gives you a sense of some of the headwinds that the banking industry sometimes periodically gets. Also in March 2023, you had 3 banks out of our 4,300 banks go under, but they were quite prominent banks in many ways. And so Silicon Valley Bank being the most notable, it got a lot of press. It was a little bit of a sentiment-driven crisis as opposed to a reality-driven crisis. And I'll get into how we don't we don't invest in those kind of super regional banks. We don't invest in the GSIB banks, the JP Morgans, the Citigroups. Those are too efficient, not interesting to us for many reasons. We focus on the small banks throughout the 4,300 banks that are throughout the United States, community banks that are local SME lenders, and they're doing a lot of asset-backed lending. They're very transparent. They're very easy to understand. That's really the focus of what this trust does. I would describe this trust as sleep at night type investing. We're not dealing with high yield debt. We're dealing with regulated debt that is only can be issued by banks and insurance companies with the approval of their regulator. And so we've had one default in our 8 years out of our over 200 names between banks and insurance companies. This is sleep at night, steady Eddie, kind of generative of income if you're an income investor. On the far right, you'll see our annualized dividend yield. That's based upon our share price. I would note over the last 12 months, the share price has gone up 12.3%. This year, it's been 3%. We've had the headwinds, which on the far left, you'll see our total return has been negative for the year. But if you look at the rectangular box underneath, the underlying portfolio is generating 8% for the first 6 months. It's really a high yielding period for us. But it's been the headwind of the FX, where we own dollar assets, and this is a pound denominated trust. Therefore, we're hedging about half is typically what we hedge, half of our assets to the pound. Over the course of an 8-year period, it kind of washes out. But this year has been a negative 8% in the 6 months. It's been 8%. It's been about 10% for the year in terms of the dollar weakness to the pound. And a lot of that has to do with the tariff liberation day policies that Trump put in. I think that's going to normalize, and I think that will, I think we will not see as much dollar weakness as we've seen precipitously this year. But the underlying portfolio has performed extremely strong over the last 6 months, as reflected in that 7.91% figure. I'm not going to spend too much time in the next 2 slides. These are our financials. I would point out that if you look at the first column with numbers, the January 25 to June 30, 2025, that second figure, that net loss of 4.9, that's where we hold our FX. So that's why you're seeing such a large kind of loss right there. In terms of our balance sheet, what I would just note here is that under total liabilities and ZEP shares, we do have debt. ZEP shares are a type of debt that's publicly traded. We did, if you look at the far right under the ZEP shares, we did have 26 million pounds outstanding. We rolled our ZEPs earlier this year, and then we basically rolled it to about 16.2 million pounds of ZEP shares. So we've reduced our debt a bit. I would actually be in favor of raising that a bit more, and we do have an outstanding prospectus and ability to raise a little bit more ZEP debt, which is term debt. We're issuing it at a GRY it's basically an 8.5% annualized piece of debt. I'm very comfortable with that, which tells you how I feel about the investment opportunities to put that work. So I would issue more of that debt if I could at 8.5%. And again, we have a public prospectus outstanding talking about that. Going back, this is again talking about EJF Capital. The one thing I didn't touch upon when I was talking about this slide is really in the bottom right. EJF Capital and our affiliates own 26% of the company's ordinary shares. So that represents approximately 26 million pounds. I personally, and again, this is all public information, I own 1.7 million shares myself. The firm and my co-owner or co-partner, Manny Friedman, plus the other affiliates of the firm, that's how we get to that 26%. So we're extremely aligned. And what we've been doing is taking our management fee over the last year and investing it on a quarterly basis, percentage of that management fee back into the trust. We love the trust, especially sadly trading at a discount. We've reduced the discount from, it was as high as, I believe, 40%. We have it down to 21%. We, being EJF Capital plus the board of the trust, are incredibly motivated to narrow that discount more. One way we found that it's been helpful to do is for us to be constantly in the market buying back or buying shares with our management fee. And so we've committed over the next 4 quarters to use 10% of our management fee to buy more shares. So I think that alignment of interest is incredibly important. In terms of the portfolio, I think that there's really 3, and I think the next slide shows it. There's really 3 main exposures that the trust has. So if you focus on these 3 areas, you kind of understand what we do. So about 70% of the trust is invested in that debt issued by banks and insurance companies, small banks, under 50 billion in assets, typically, definitely under 100 billion, encompasses all of the universe that we invest in. So about 1,200 of those 4,300 banks, that's what we invest in, the debt issued by those banks. And it's regulated debt, as I mentioned. And so that's about 70% of the portfolio. We take that debt and we package it into match funded. It's a securitization is the structure, but it's match funding. So we're getting, we don't have margin call debt. We don't have, kind of gun to your head type debt. We literally have debt that is matched to the underlying liabilities of the debt. And that's how we get structural leverage. So that's how we're able to get mid-teens returns on our securitization yields. So that's what 70%. The next part is related to that. So when we have the CDO manager that manages those structures, we have committed 49% of the fees from the CDO manager to the trust. And that's a really nice thing. It gives a quarterly cash flow to the trust. When I mentioned about our dividend yield, I failed to mention that over our 8-year period, we've never missed a quarterly dividend. We've increased it twice. I would hope to do that in the future. Of course, I can't promise that to you, but given our underlying investment opportunities, that is something that would be foreseeable. And we've never reduced it. We've never temporarily suspended it. That dividend, like I said, is sleep at night, steady Eddie. We feel very, very good about the dividend. The third area is credit risk transfer, and that's an emerging area. And that's an area that's a reasonably well-trod path in Europe. Europe basically has a lot less banks. England, for example, or the UK, I should say, the UK has 100 domestic domiciled banks and 100 banks like at the HSBCs of the world. That's the most notable, that are foreign banks, but that can do business in the UK. So 200 banks, 65 million people. America has got 4,400 banks, and we've got 6 times the population. So it's a very, very different financial ethos. And one of the things that's happened over time is that there's been a consolidation of that banking system. I've been in business 25 years, and there were 12,000 banks 25 years ago. There are now, again, 4,300. That is a tailwind to what we do, because if you own bank debt and you have 2 banks, one's the larger bank, let's say it's a 50 billion asset bank, and then you have a bank that's a 5 billion asset bank. The way their regulated debt's going to trade is very different. The bigger bank is going to trade to a yield like 6.5%, 7%. The smaller bank is going to have to pay a higher interest rate, so it's going to be 8.25%. Well, guess what happens when those banks merge? When the bigger bank acquires, or it's a merger of equals, also this is the case, but this is more demonstrable with the bigger bank acquiring the smaller bank. The smaller bank's debt, which is non-call for 5 years, that debt is still outstanding, but it's going to trade from 8.25% down to what the debt levels are of the acquiring bank. So it's going to go to that 6.5%, 7%. So that's an uptick in value. So it's not just that we're clipping coupons. We are, because we're bank experts, because we as a firm invest across our universe of our different products. We invest in bank equities. We invest in private bank equity. We've been investing in the debt for 20 years. And because we do fintech, we know the banks and we know the management teams well, we serve on boards. We've been doing this for a long, long time. As a consequence, we really have access to management teams and the issuance of the debt and really understanding the banks well. And like I said, that's how we can feel comfortable with our roughly 45 people focusing on 1,200 banks. And so that's, I think, the major edge that EJF Capital brings to the trust. The last strategy is credit risk transfer. I went through that whole what's our edge because it plays into what we've been doing in credit risk transfer. We have been applying credit risk transfer, which has been done a lot in Europe with the big banks, and it's been done a lot more in the US and the big banks since September of 2023, when the Federal Reserve said, you can do credit risk transfer. Europe's been doing it for 7 years, but we're blessing it. And so once the Fed blessed it, the big banks go in with both feet, and they've been, JP Morgan's, Bank of America, they've been serial issuers of CRT. The small banks, there's only been 6 transactions. There were 127 last year. Only 6 were by banks under 50 billion in assets, and EJF Capital did 4 of those. So we have an edge with these small banks. And what CRT is taking a basket of certain loans that the bank has that we, the buyer, get to select, and we put them in a box, and we put on a first loss piece on that. It's basically insurance, and you get a high rate of return that's higher than the underlying loans are generating, and the bank is willing to pay you that outsized return, that mid-teens type return, because what they're doing is reducing their capital exposure to those loans. And that's done with the blessing of the bank regulator. In the case of our banks, it's typically not the Fed, which is just more the big banks and the systemic banks. It's the FDIC. And so that whole process of selecting loans, bucketing them, structuring it, and then going to the regulator, that's something that EJF Capital has been doing, holding hands of smaller banks and getting that process done. So this is a nice area. We've been getting anywhere from 13 to 22% on. We've done 3 CRT transactions. I expect that right now it's about 8% of the trust. I expect that to grow to 20 to 25% over the next year and a half. And I think that's a very diversifying, nice yielding. And it's really important because we get to select those credits. That's really, really important. And because we're so involved with the bank, seeing the loan tapes, making those decisions, helping the bank make those decisions, that's what gives us pricing power. So that's the third area. So if you go back to this slide, you'll see that this is that the chart at the bottom kind of or the bar graph reflects where our assets are, right? The biggest bar graphs are in our bank debt and insurance debt exposure, and then our other pieces. We do carry a fair amount of cash as a typical situation, because when we do a funding of a basket of debt pieces, typically 50 at a time, we deploy that cash, and then we fill the bucket with the yields off of our debt, and then we do the next one. So we've done 2 this year. As an example, we've done two of these securitizations this year. We did one in March. The underlying yield of the tranche that we hold and keep at the trust is 16%, 15.85%. That's, again, a projected yield to maturity, assuming no defaults. The one we just did in September, that has a projected yield of 18%. So we've been doing this for 8 years, and we've been doing it in a low interest rate environment. 2017 to 2021, that was historic low interest rates. So guess what? The debt issued by banks, also historically low. And they issued a lot of it because they're not dumb. Banks are not, managers are not dumb. They know if the yield curve is quite cheap, they're going to issue this debt. And it's 5-year debt. And it's fixed for 5 years. That's for regulatory purposes. And then it floats for 5 years. So banks get great regulatory treatment for the first 5 years, and then they refinance it. So 5 years ago from 2025 was, guess what? 2020, really low interest rates, right? Because of the COVID crisis, and the regulators responded to that, I think, the right way. They lowered rates, they kept things going. 2021, same dynamic. 2022, same dynamic. And then in April of 2022, then the Fed went through a rate increase cycle. So we have another, in our view, about 2.5 years. There's going to be a lot of refinancing and a lot of issuing of sub debt, and that creates great opportunity. And the rates in today's markets are anywhere from 6.5% to 8.5%, fixed for 5 years. That's great in a environment which is a cycle that we believe, that EJF Capital believes which is that the Fed is in a easing cycle. Some of that's been politicized by Trump, but it doesn't matter really. It's happening, and so that's the important thing. I'm going to skip over this slide since I already covered it. In terms of our, this is a very, very important slide. There's a lot of numbers on here, but I'll kind of break it down. The numbers on the right are basically a little bit of a repetition from the first slide. But what the slide in the body of it's kind of going through is what is the risk of the kind of debt we're buying. And the 70% roughly that we're doing in debt issued by small banks, insurance companies, that's corporate debt. That is, if you look through it, and I'm basing this not on Neil or EJF coming up with a rating. When Moody's rates our securitizations, which they do, the underlying credit is a investment grade, BBB minus level of risk. So very, very different than CLOs. That's high yield debt, which by definition is not investment grade. So we are doing investment grade debt, and I think that 1 out of a 200 pieces of debt default rate kind of demonstrates that. I think we're good at our selection of debt. It's not super risky debt. This is must-pay debt that banks must pay. It must be approved by the regulator before they issue it, and if they don't pay it, then the regulator can seize them or make them combine with the neighbor bank. So it's really, really good debt. The fees that we're sharing, the CDO management fees, that is paid before the rated paper. So that's senior to, that's the third item down. The money market's obviously cash equivalent. But the CDO management fees are paid first in the structure. So there's no credit risk there. There can be duration risk, but it's no credit risk. Then our CRTs, which are a little bit harder to define. It really depends on what the underlying loans look like. But again, because we're selecting those, and typically banks, when they do a SRT, CRT, they're putting in their best loans because the purpose of doing it is to get regulatory relief, not to throw their bad loans into a bucket. No one's gonna buy that. No one's gonna give first loss on that. They're only gonna give it on their best loans. So that's literally how CRT works. It serves a regulatory purpose for the government. It serves a regulatory purpose for the bank. It also releases capital so that they can put it out in today's market at a higher rate than they were 4 or 5 years ago. And for us, the investor, we can make a mid-teens return. So it's kind of it's a mutually beneficial structure, and we think it makes a lot of sense. On the NAV bridge, again, I'm not going to spend a lot of time, but I'll just point out that the dark blue is the NAV at the beginning of the year. Far right blue is where we are at the end of the year, and the moving parts are the other components of the NAV bridge. I'm sure you've seen these before, but you'll see that our gain of 7.6 is offset by the negative 8 million pounds in FX. So that's really what this this shows you in terms of demonstrating things. Now going to the discount. What I'm going to focus on here is the bottom right, and I think you'll see that again our share price, over the last 12 months is positive 12%. If you go back 18 months, I think it's more like 28%. It's because we have been doing things to get that discount, that NAV discount down. So one has been us buying shares. Number two is we're doing a tender, which I'll get to in a minute, going through the details of the tender on the next slide. But the board authorized a 5% of outstanding shares tender, and that will be it's open right now. We have public documents that are on our website and are in our RNSs. It's open right now for shareholders. I think it closes, sometime in October or October like 13th, 12th. We'll get to that in a minute. But by doing that tender and doing it at a 5% discount to NAV, that we're trading at a 20% discount, 21%. That would logically help not only people getting liquidity close to NAV, our current shareholders who have been with us, from the beginning, let's say, it also will have an arbitrage effect, and folks should be buying shares, understanding that they can take some of those shares and turn around and frankly, they could be bought out of in the tender at that higher discount, or lower discount. So it's really something that it's a well-trod path. We've never done a tender before, so this is next 5 years. The board has approval to do a 5% retirement of shares, so we think that'll have an impact. The third thing we've done is really hired some dedicated resources to going out and talking to investors, prospective investors like yourself. That's something that we don't typically do. This is the only product that we have that's really open to the public. It's retail. We have no other public vehicles. All of our funds, that $5.5 billion, is in private structures. Our clients are institutional type products, or institutional clients. And so as a consequence, we really have been, and it's really, my fault as CEO. We haven't pushed out to the public in the UK in particular. It's really showing dividends. We've been doing that for the past 6-7 months. It's really made an impact. Our volumes have gone up triple the amount, and that or 3 to 4 times, somewhere in there, from where it was 1 year ago. That makes a big difference in terms of getting the word out, getting interest in the shares, for good reason. I think it's a great trust. In terms of the tender offer, this gives you some of the details, but I think I've covered most of it. It's a 5% per year. We're doing a 5% now. You can see the key dates at the bottom. The elections for existing shareholders are due 13th, and then it'll get settled in late October. So, we think this is just, again, part of our effort to narrow that discount over time. I'm now going to go over a little bit of the banking system and drill down a little bit on why invest in small banks. Again, I've found it, being in the UK for many years, talking to investors, that you have to explain that we're very, very different than the UK and Europe in terms of our banking system. Again, because we have those small banks. You can see this chart is a great chart. It shows there's only 14 banks. If you look at that bright blue ribbon, the second one down, 14 banks representing 7.9 trillion of deposits. Those are the GSIBs, the globally systemic money center banks. We don't invest there. We may, in our equity funds, maybe short them once in a while, but that is not an area. It's too efficient. It's not a place where we can provide the kind of returns and value creation that we can with the small banks. The regional banks, that's that second tier. That's where the 3 banks that went under in March 2023 was Silicon Valley Bank, First Republic, and Signature Bank. Those were in that category. Again, we had no exposure in the trust to those names. Why? Because those are very idiosyncratic, typically banks, at least the ones I just mentioned, with the exception maybe of Signature, which was a little bit more broad bank. But the other 2 banks were very mono industry, tech oriented. They had particular strategies that were very monoline in nature, and we just don't like that. We like the well-balanced bank that's doing SME and asset-backed type lending, and that's that third category, that first one, small banks, 0 to 50 billion. And the key thing to point out is at the bottom, which is M&A, it is robust, and that's what's interesting. And it was a lot less robust under President Biden. Which I can show you graphically here. The M&A activity over the past 4 administrations. Now we're Trump 2.0, which I'll get to in a second. That really Biden's administration really sticks out. They were the regulators in the seats were anti M&A, not just in small banks, but just in general. The Trump, again, you don't have to love the guy, you don't have to hate the guy. It doesn't really matter. When you think about the regulators and people he's put in his seats, it is increased the number. We've seen it already in the first 9 months of his administration. There's been 117 bank mergers. They're happening quicker time. And that's because if you look at Trump 2.0, he is, and the people he's putting in seats in the financial seats are, as it applies to banks in particular, that is very conducive to M&A. So the FDIC chair, Travis Hill, he literally came out and said, look, there's essentially a new sheriff in town. If you meet the requirements of the Bank Merger Act, we'll approve it. what's the sentiment behind that? Well, look, technology is just driving a lot of this consolidation. And as a regulator, you're only as good as your weakest link. So you really want actually less banks. I mean, it's easier to regulate. It reduces some of the cyber risks that are involved because technology spends are very hard. And from a bank's perspective, they get typically 25-30% cost savings by merging. So we're seeing a lot of this. We expect a lot of it to happen, and that's absolutely good for the trust. Other things under Trump 2.0, the one big beautiful bill. Again, that's maybe not an apt name, but it doesn't really matter. What it did is it did give certainty, and that's really good for business. So banks are corporations, insurance companies are corporations. They are paying corporate debt or corporate taxes. The one big beautiful bill extended that lower rate and made it permanent. That gives planning. That's very good for the small banks, insurance companies. Michelle Bowman is now the vice chair of supervision at the Fed. She is her whole career, her family have been in community banking for generations. She understands small banks. So the idea is not to have deregulation, meaning let's have lower underwriting standards. That's not the case at all. It's more let the banks not be subject to some of the same rules that apply to GSIB banks when it doesn't make sense, and allow them to merge if they want to merge, and let the review process go quicker, or allow it to go quicker. So that's really what we're talking about when we say, what are the bank regulators doing in terms of deregulation? Banks, since the great financial crisis, in the banks that we invest in, have 50% more capital than they did back in 2007, 2008 at the time of the crisis. So they have much higher regulatory capital levels that are loss absorbing, and they also they also have much higher underwriting standards. And I think we have a chart here that kind of makes this very graphical. If you want to know where the risky bit of lending has gone, in my opinion, it has gone into the shadow banking system. And what is that? That's private credit funds. That's non-bank lenders that are not subject to the same regulatory scrutiny and constraints. And that's why you've seen this massive shadow banking market take off. In the last 5 to 10 years, private credit has exploded. That's where the risky bit of banking has gone. We're starting to see in the last 2 weeks, you're starting to see some subprime auto non-banks having issues. You're starting to see some of the cracks of some of this non-regulated banking, where you have leverage levels and bank underwriting or lending standards that are not the same as a banker, which is our typical banker management team, which got through the crisis. They're experienced. They're the ones who made it. They're the ones who understand it. And they're the ones who can work within the construct of a regulated system. And we really like that. So let's see if I've missed anything now. In terms, I've touched a little bit on why now. I think the important thing to understand is that there's a lot of, you can see the bottom left, small bank subordinated debt is $44 billion in size. We expect about half of that to get refinanced over the next 2 years, 2.5 years. That's creating a lot of activity. The other thing is that M&A, before you do a merger, a bank has to have elevated capital levels. Why? Because to get approved, you have to go in there, and big bank or $50 billion bank in my example, and the $5 billion bank, you have to have higher capital levels just in case that some of the representations you made about some of the loans are accurate. You have a little bit of a cushion, a little bit of buffer. So what's the quickest way to get higher regulated capital is to issue this subordinated debt. You can do that. You might have to pay a little bit more. You might have to pay 8% instead of 7.5%, but you're going to issue it because you want to have that merger. Because when you do that merger, you can eke out 25-30% savings, much bigger than the slightly higher cost of issuing the debt. So it makes a lot of sense for banks to do that. In terms of history and banks, we get this question a lot. What about small banks? We read all about it in Bloomberg. They have high exposures to real estate. And this is a great chart just showing you where net charge-offs are defaults, right? CRE, it's commercial real estate, construction, charge-offs. Okay. This is showing you, by cohort of bank, where are the default levels historically? And the Great Financial Crisis, which was an asset, kind of based crisis where the banks had lower underwriting standards, they had a lot of real estate exposure that wasn't strong. That's not the case where we are in today's world. I'm sorry, this is the cohort one, which shows you by different type of bank by size, and you'll see that the banks that are doing the write-ups, are in the big banks. These are the banks that are over 100 billion in assets. And why is that? Because where the problems come in are not lending to the dry cleaner who has an owner-occupied office and you have a personal guarantee. It happens on these big urban multifamily, $100 million loans where the developer who can't make it work because rates have moved on them throws back the keys to the bank. That's where that happens. It doesn't happen with these small SME lenders. They can't make those type of loans where you see the biggest risk. I've talked about the shadow banking system. And the last one I would just point out is this is something that JP Morgan puts out, but it's based on the Federal Reserve stats. But bank defaults, you really have to focus. Charts can be misleading, but if you look on the left, you'll see that the scale is there's just not bank failures really happen. One, they happen in waves. Two, they happen when there's been a heart attack to the system. And we just don't see that anywhere in sight in terms of small banks, given the higher capital levels, given the tighter underwriting standards. It's just something that we're not frankly worried about. And in terms of deposit flight, which we get that question a lot, the market since 2023 has really responded to that. Banks can join and have joined. 2,500 of them have joined, where you can go in and any deposit. In America, FDIC insures up to 250,000. Those can be spread over 2,500 banks. So you can have actually up to 50 million of deposits insured by being part of this consortium. By being part of it, you get a slightly lower deposit interest rate paid to you, but that's a trade-off that certainly makes sense, and the market has responded. That's a market product that works quite well. Okay, I'm going to fast forward past these slides to kind of get to a couple more slides, and then we'll take some questions. So looking forward, so I've taught a bunch about this, the CRT, but let's just focus on that middle point, which is why it's an attractive opportunity now. And again, this may not be in 5 years or 3 years, but it certainly is, in our view, in the next 2 years. We have pricing power because, again, we're going in. These are bespoke transactions. We're working with individual banks. We're getting reverse inquiry, from the banks to us. We get to choose the credits. That's very different than SRT that's issued by the big banks. It's a kind of, do you want to buy it? Take it or leave it. We'll disclose what kind of loans we have in there, but you can't debate about it. You can't negotiate. Take it or leave it. If you don't like it, you don't like the rate for the risk you're taking, too bad. That's up to you. This is different. We're doing these bespoke, and we're the only buyer because the size of these transactions are typically under 100 million in size of loan basket. So the CRT we're buying is 20 million, and then we get to affect the structure, which of course protects us. That's very important. And we've kind of gone to the banks and said, here's the structure you should use, and here's why it's advantageous for you. Here's why the regulator will like it. And here's why our investors will like it. So that's why it's worked. So again, I mentioned this earlier, but I would anticipate that this increases to 20-25% of gross assets. So one example I would give, and then I'll do one more wrap up, is that we did one of our first CRTs was with a Tennessee bank under 100 billion in assets. And it was a prime jumbo mortgage pool. So these are the larger mortgages they have to keep on their balance sheet. They can't sell them to Fannie and Freddie. They make that loan knowing that, because they're jumbo, and they're prime. These are 760 FICO and up. These are their best private clients for this bank that's domiciled in Tennessee. Its imprint is some of the best in America: North Carolina, South Carolina, Georgia, Tennessee, growing area in the Southeast. when we did the transaction, we got basically a 13% return. It's in the lower end for CRT, but given the risk, happy to take that return. The same week, JP Morgan issued a prime jumbo mortgage pool, 400 basis points lower. So the credit's the same. Doesn't matter if JP Morgan's clients are in Tennessee or New York or in Utah, they're prime jumbo mortgages. And so were what we were investing in. And we got a 400 basis point pull up because we helped that bank do their first CRT ever. And so that really is the edge that we're bringing to it. So, so just kind of in summary, I think this is a very sleep at night, steady Eddie type trust for income investors. I think the time is really great now because you're going into a interest rate, kind of easing cycle on the front end. Banks pay depositors at the low end of the front end of the curve, and they lend at like the 5 to 7, like the belly of the curve, 5 to 7 years. That has not gone down. Some of that's expectations of tariff inflation, but it's also growth because Trump is stimulative. He was in his first term. We expect him to be stimulative the second term, and the One Big Beautiful Bill does help that. Lastly, on the tariff risk, which is a big risk, I wrote about this in our last thematic outlook in January. Small banks don't lend to foreigners. Typically, the small banks we're dealing with, they're more domestic facing. They have less than 1% of their deposits are foreigners, and it's typically Canadians, and less than 50 basis points of their loan activity is to foreigners. JP Morgan, by contrast, is in the GSIB bank, that the big banks, they're more international. 17% deposits are foreign, 12% of loan activity. So they are more impacted by tariffs. But everyone's impacted by tariffs. I'm not a fan of tariffs, but some are less so than others. And so if you're going to invest in financials and you like that steepening yield curve, which is great for banks of all stripes, this is I would submit to you a good place to be doing it. So maybe with that, I've gone on for quite some time. Maybe we will take some questions, Alessandro, if that makes sense.
Yes, of course. Well, Neil, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. We have received a number of questions, both pre-submitted and throughout today's live presentation. I'll start the Q&A session off with the first question here, which reads as follows. How would the projected lowering of interest rates by the Fed affect the trust?
Yeah, I think hopefully maybe this was submitted before I said that last bit, but when basically banks are spread businesses, they borrow their cost of capitals from depositors and from sub debt investors. That's typically done at the low end, the front end of the curve, and they lend at 5 to 7 years, and the curve's been steepening. The spread is wider. That's been a good time. The toughest time for banks, and I did not say this before, the toughest time for banks is really when you have a flat or inverted yield curve, where you have the opposite, where the front end of the curve is flat to the belly of the curve, or it's inverted. That's what we had in 2020, 2021, 2022. That was the toughest period for banks. We're kind of walking into the best period for banks with a dovish cycle of short-term rates going down, but not the further end of the curve.
That's great. Thank you very much. The next question we have here, what does the opportunity set look like in the CRT space?
Well, I'll take that as a question about what asset classes. So I mentioned residential prime jumbo mortgages. Most mortgages in America are sold to, those are conventional mortgages. Those are for like most Americans. Those are sold to Fannie and Freddie. Banks don't have a lot of exposure on that on their balance sheet. They just book a fee and sell it to Fannie. So prime jumbo, they have to keep those in their balance sheet. That's one area. Another area is construction loans. And again, these are local construction loans of small, moderate size. Those tend to get high capital charges. And so that's an area where banks like to kind of basket those and put them in. So those can be a little bit riskier. But again, we get to pick the loans and we get to charge them more. So we've had one as high as 22%. So for us taking that first loss, and that one is 2 years into a 3-year duration, and we've had 0 defaults, no problems, a couple prepays. It's been great. So it's going to be real estate related primarily because we like asset-backed, kind of CRTs. We don't want to do too many esoteric type CRTs. That doesn't make a lot of sense. And small banks don't have a lot of that opportunity anyway. Banks are really asset-based lenders.
Thank you very much, Neil. The next question, do you intend to increase the size of the trust?
Absolutely, and we have had in the past two capital raises. They were modest, but they were like 15, 20 million pounds. But if we can narrow this discount, which we've done in the which we had the benefit of early days, we would absolutely. And if the question really is how big can it be, and can it bigger is going to be trading more, so that's good for everybody. But in terms of the opportunity set, EJF Capital is basically doing what we're doing in this trust in our other funds, which are represent about another $450–500 million. So this trust could be 4 times as large, and we'd have plenty of opportunity to do exactly what we're doing and not changing it and getting a mandate drift, which is the worst thing we can do. So that's the trust really needs to grow.
Thanks very much. Another question we have here. How do you identify which regulatory shifts are investable rather than just noise?
Yeah, that's a very good question. So for us, it's about what affects the big macro trends. So what affects M&A, for example. So when there's a regulatory shift, like under Biden, to have more lending in poorer areas, that can be helpful, but it can maybe not be helpful. Regulatory shifts on what's the capital charge against like energy lending, for example, which we don't like because it's too volatile. That is something that typically we don't care about because we don't like the exposure anyway. But things like stable coins, that's interesting. Being the regulatory shift being pro crypto, that's a lot of that's noise. But stablecoins, not noise, because banks will be issuers, in our view, under the Genius Act that just passed, of stablecoins that will be a kind of alternative form of getting deposits. And they'll, again, a way a stablecoin issuer makes money is you give me $1 or you give me £1, I give you £1's worth of this crypto, and I get to take the pound and I invest it in non-risk, sort of risk-free treasuries and MBS, and I make that interest and you don't. So that's banks. That could be a good spread business. That could be really interesting, and we think that is the future. So that's a shift that's important. So yeah, we look at every little aspect of one big beautiful bill, and we parse it out: what's relevant, what's not relevant, what's grandstanding politicization of things, like just crypto generally, versus blockchain, and understanding that payment systems are benefited by blockchain, and stablecoin, for example, will benefit the payment system ecosystem. And I think Andrew Bailey just announced that yesterday. He's understanding that finally at the BOE. It's going to help payments, but crypto generally, who knows? But blockchain technology, absolutely good for payment systems, and banks will take advantage of that in our view.
Perfect. Thank you very much. Another question we have here from an investor. What steps have you taken to narrow the discount?
Yeah, now this is a little bit repetitive, but basically the steps have been: we've been in the market buying shares on a regular basis. We being the board, I'm not on the board, but the independent board did, at our kind of, prodding to some degree, or convincing, I should say, is doing a tender offer program. So we'll see how that goes, and we'll see if it needs to be modified, or see if it has an impact that we hope it does. And the third is really just investor engagement. I know that sounds kind of like that. Well, what's that going to do? Well, if you've done very little of it and now you're doing a lot of it, it will have an impact, and we're already seeing that in volume. So those are the main things. And then, of course, if we could grow the trust, it's a virtuous circle, then that would also narrow the discount.
That's great. Thanks, Neil. And the final question we have here is, how does your investment philosophy and execution differ from the broader market? And why do you believe this provides a better risk reward profile?
Well, that's an investor philosophical question. I'll answer it this way. I've been in asset management, for almost 25 years, and the business has become very bifurcated from the firms that have something to offer everybody for everything. There's been a lot of consolidation, a lot of big boys, I'll call them. I probably should say big persons, but just kind of those folks, the ones who've gone public and taken advantage of the market. And then there's the niche players who really just focus in one industry, one area. Obviously, we fall in that second category. But when you're in that niche, you can't be sitting there and going, I just do one thing, but we do one industry, and we focus on, and by focusing on regulation, you're always focused on what's coming around the corner. We're in Washington, D.C. We're dealing with legislators. We're dealing with, both senators and members of the House, people at the agencies. We kind of see where things are going. Where's the puck going, to use the hockey analogy? And so that's I think, I think that's why we think we can get a better return. And the fact that institutions invest so much with us, I think proves that point, is that we're the experts in this particular area. We can drive alpha in that space, not every time, not every year, not every month, but over the course of our 20 years, we've been able to show that we're nimble and that we know what we're doing. And I think this trust is an expression of that. Again, it's not a sexy trust. It's not going to give you 20% returns, but it's also going to be steady Eddie, and it's going to give you that income you need if you're an income investor.
That's great. Well, Neil, thank you very much for answering those questions you can from investors. Of course, the company can review all of the questions submitted today, and we will publish the responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to yourself, Neil, could I just ask you for a few closing comments?
Yes, no, look, I think we've had a strong 6-month performance based upon the underlying assets, which is all we can really control. We can't control FX markets. We don't try to take a viewpoint on FX. That's not why you should invest with us. We're going to be about 50% hedged at all times, and that, again, works in your favor, works against you depending on the time. But over the long glide path, it's become sort of an irrelevant factor. But that first 6 months of 8% performance, I think, tells you a lot about the direction of where this trust is going. We guided, when we set this up, 8 to 10%. We've hit that on a consistent basis. And like I said, if you look at investing from a risk reward perspective, not just what's my upside reward, I think this trust really fits nicely into a portfolio. It's a good complement for those who like to invest in CLOs. It's a very different asset exposure, and it's also encompasses something that is not available, to my knowledge, any other investment trust in the UK, in Europe. You're getting U.S. small assets that only institutions have access to in our private funds, and we're offering it in a public vehicle that investors can invest in. So we're really proud of that, and we're really happy to be doing our business here in the UK and in Europe. And we really appreciate your time today. And thanks again to Investor Meet Company, and Alessandro, you've been terrific. Really appreciate it.
That's great. Well, Neil, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team for EJF Investments, we'd like to thank you for attending today's presentation, and good afternoon to you all.